I'm Grant Walker. Welcome to Last Call for Tuesday, the 30th of June. I'll be back Wednesday, 10 a.m. To Greece and our markets, although it's going to be a volatile week, New Zealand markets have already weathered the Greek storm. Hamilton Hinden Green director Grant Williamson says New Zealand markets have already taken a hit from the Greek financial crisis. He said we saw a sell-off yesterday as it was known that the offshore markets were going to be weaker overnight. Mr. Williamson says he wouldn't expect a big sell-off of financial stocks today, but warns that in Australia there could be continued selling in the banking sector. He said it's going to be a very volatile week. It won't go in a straight line, and we will get some bargain hunters coming into these markets sometime through the week. Mr. Williamson says this week will be all eyes on the euro. He said normally what happens in times like this, where there is a bit of financial turmoil overseas, is the smaller currencies do get sold off. He said with the New Zealand dollar, we have held off quite well against the US, but we've lost a bit of ground against the euro overnight. He says it's hard to predict day to day, but until the uncertainty of Greece is removed from the market, there is going to be a tendency for the downside. In the worst day for US stocks this year, the Dow Jones closed down 350 points, that's 2%. The S&P 500 dropped 1.85% to 2,062. Despite this, Mr. Green says Asian markets were probably expecting the US markets to be down even more than they currently are. Meanwhile, Massey University professor Christoph Schumacher says the chance of Greece defaulting is very real. Greece hasn't got the money, he says, so it needs access to the final $7.2 billion instalment of the EU bailout fund. The EU, however, won't release these funds until Greece agrees to significant reforms. If Greece continues to reject reform measures, the EU is unlikely to bail it out. But while Greece is hogging the headlines, a sell-off in Asian stocks is perhaps more of an issue for New Zealand investors. Global fund manager and PM Capital founder Paul Moore told the Australian Financial Review the bigger concern was China. He said, look at the size of the Greek economy, it's a speck. China's not a speck. Chinese stocks are firmly in a bear market after the Shanghai Composite fell 3.3%, extending losses to 22% from its peak. To our poll result, NBR online readers say the government should introduce KiwiSaver auto-enrolment for everybody. Yesterday, Prime Minister John Key signalled mass KiwiSaver enrolment is on the way as one provider, ANZ, said enrolments have more than halved since the $1,000 kickstart was axed in Budget 2015. Mr Key told Breakfast the government may well move to auto-enrolment for everybody, despite the already huge incentive for people to join KiwiSaver. Although it moved to support auto-enrolment for those starting a new job with an opt-out provision, the government has previously rejected mass auto-enrolment for everybody with an existing job as too expensive. But 68% of NBR online readers say the government should move to introduce mass KiwiSaver enrolment. After Budget 2015 in May, Finance Minister Bill English said the elimination of the $1,000 incentive paved the way for an auto-enrolment initiative. He said we're keen on this, what we call mass auto-enrolment, and that is auto-enrolling everyone who's not in the scheme so that they then have the opportunity to opt out. With the kickstart payment no longer in place, that's much cheaper than it used to be. Yesterday, Mr Key added, it's always been about affordability for us, and you've got to make sure that when you sweep everybody up, there is provision for those who genuinely can't afford it to be in or don't want to be in to come out. Mr Key says the removal of the 1,000 kickstart might mean there is less incentive for people to sign up their children because they were previously banking the $1,000 without necessarily making any further payments. KiwiSaver was introduced by the Clark-Cullen Labor government in 2007. Mr Key said there are now 2.5 million savers in the scheme.
NBR Radio on Tuesday, the 30th of June. With me, Hamish McNichol. Hamish, you've been following the case of this lawyer struck off, Mr Yee, previous political associations as well too.
Yeah, he was a former National Party candidate and he served a couple of terms in the Manukau City Council as well. Kenneth Yee, he's been struck off the role of barristers and solicitors for misusing $600,000 of client funds.
Just give us a bit more detail about the nature of his offending.
Yeah, so the tribunal found that he misused money in a couple of ways. He's actually paid back more than $500,000 of the $600,000 that he misused. But this $500,000 he took as a loan from his law firm's trust account and basically paid it out to a series of his own companies. So he has paid that back, but he still owes a further $95,000 in fees which were diverted to companies he was associated with. So that was directly taking money away from his law firm and paying it to himself, I suppose. The New Zealand Law Society National Prosecutions Manager Mark Trelevin basically said This is totally unacceptable and basically flies in the face of what is known as a solicitor's trust account and is perhaps the greatest breach of trust of that you can have.
Yeah, so, it's just a reminder of the fact that you cannot take money out of a trust account for a short-term loan, even though you might know that you're in a position to repay it at some point in the future.
Yeah, absolutely. I guess, he's managed to pay back that $500,000 that he did take out as a loan, but it's still pretty poor practice, you'd think. In terms of his political career, he was ranked number 58 on National Party's list back in 2005, so not that prominent a figure. We couldn't find a photo of him or anything like that online, but interesting wee case, and certainly a wake-up call for those in the industry who might be fleecing client fees.
How are these cases actually detected, Hamish? I assume the Law Society does spot checks on trust accounts. That's how they discover these irregularities.
I'd imagine so, and I think there's a complaints process as well, and the law firm that he worked for itself might have easily picked up on this as well and made a complaint from which imagine it was fairly easy to stack up. So, there's all sorts of ways that you can do these sorts of things.
All right, so he's struck off and paying a fine as well too?
No, just struck off as far as I'm concerned, but I imagine that they will be chasing that $95,000 he owes in fees still. They said it's yet to be repaid, which certainly implies that it's still an expectation for it to be paid back.
All right, thanks for the update. Hamish McNichol with us on NBR Radio.
NBR Radio with Bailey's, New Zealand's leading commercial real estate company.
In construction news, New Zealand building consents were virtually static in May as dwindling demand in Auckland offset increased construction intentions in other parts of the country. According to Stats New Zealand, seasonally adjusted consents for all dwelling types was little changed at 2,151 in May from 2,150 in April. Housing consents rose 2.4% to 1,520, following a 1.8% decline in April. On an unadjusted basis, new dwelling consents rose 2.2% to 2,171 in May from the same month a year earlier, though new housing consents dropped 5.8%. Apartment consents retreated from a 7-year high, falling 21% to 115 in May from the year earlier. New consents for retirement village units rose 45% to 184, while permits for townhouses, flats and units jumped 71% to 285. New dwelling consents in Auckland, New Zealand's most populous city, fell for the first time since January, down 29% in the month of May to 651. Westpac Banking Corp economist Michael Gordon said in a note, a pullback in consents in Auckland was offset by gains in the rest of the country. The main driver of the Auckland figures was a drop in the multiples category, that's apartments, townhouses and units. He said there's no real cause for concern as this category is quite volatile and the April total was the second highest in the last decade. Today's data shows consents fell on a monthly basis in 3 out of the country's 16 regions, with Hawke's Bay and Nelson declining, while consents on West Coast were static. Wellington consents increased 25% to 150 last month, while Canterbury consents rose 29%. The New Zealand building industry has been stretched to keep up with demand in Canterbury, where the country's second largest city, of course, is recovering from the earthquakes, and in Auckland, where a shortage of supply has pushed real estate prices to record levels and seen a resurgence in new home builds. Westpac's Mr Gordon said, notwithstanding the latest monthly figures, the centre of gravity in the home building industry is clearly shifting from Canterbury to Auckland. The residential side of the post-quake rebuild is now well advanced, while Auckland still requires a further lift in building activity to meet population growth. On an annual basis, Auckland dwelling consents were up 6.5% in May compared to the same month a year earlier, while Canterbury dwelling consents declined 9.3%. The value of residential building consents rose 3.3% in the month of May to $714 million, while on an annual basis it increased 13% to $8 billion. The value of non-residential building permits rose 32% to $486 million in the month of May. On an annual basis, the value of non-residential building consents rose 22% to $5.4 billion. To the banking sector, New Zealand has signed on the dotted line and formally joined the China-led Asian Infrastructure Investment Bank, or AIIB. Finance Minister Bill English signed the agreement in Beijing today, which will see New Zealand taxpayers fork out $125 million across 5 years. Mr English says the contribution will be of long-term benefit to New Zealand's economy. He told NBR Radio the intention of this bank is to complement the kind of investment done by multilateral institutions such as the World Bank and the IMF. The AIIB has investment capital of $100 billion, with contributions from many countries including India, Russia and Australia, and will address some of Asia's infrastructure needs. The bank aims to invest in basic infrastructure in Asia, such as reliable electricity, access to clean water, sanitation facilities and transport. Economists forecast the investments will make a noticeable difference in the region, creating numerous jobs and lifting many people out of poverty. Mr. English says the bank will provide capital for economies where New Zealand has a long-term interest. As New Zealand was one of the founding 57 members of the AIIB, in fact was the first Western nation to join the negotiations, Mr. English says the country has an influential role. But New Zealand's contribution is dwarfed by that from countries such as India and Russia, which are contributing $8.4 billion and $6.5 billion respectively. Despite including many world economic powerhouses, the US has opted not to join the AIIB along with Japan and many African nations. The US has urged other countries to think twice before joining the bank, citing lack of transparency. The establishment of the AIIB has led to even more friction between the world's two largest economies. New Zealand International Business Forum Executive Director Stephen Jacoby says New Zealand is one of the few countries in the world which has good relations with both China and the US. But he warns when elephants fight, it gets tough for the guys in the grass. Mr. English says he's not been in contact with the US at all over New Zealand's involvement in the bank. To business confidence. New Zealand business confidence turned negative this month for the first time since the Christchurch earthquake in February 2011, led by a gloomy agriculture sector. According to the ANZ Business Outlook survey, a net 2.3% of firms were pessimistic about the general economy over the year ahead, turning from a net 15.7% who were optimistic in May. A net 23.6% expected their own business to grow in the next 12 months, down from 32.6% last month and hitting a 3-year low. The New Zealand dollar weakened to 68.12 US from 68.37 immediately before the 1 p.m. release of the survey. Agriculture was the most downbeat sector in this month's survey, with business sentiment, profits, employment and investment intentions all negative. The average price for dairy products, New Zealand's largest commodity export, have fallen to their lowest level since August 2009 on the benchmark GDT auction, prompting farmer confidence to slump to the lowest level in a decade in the second quarter. The Reserve Bank estimates a quarter of dairy farmers are operating in negative cash flow. ANZ New Zealand Chief Economist Cameron Bagri said the economy is showing signs of heading off-piste. It's not a crevasse, but a crack has opened up. In the agricultural sector, a net 28.9% were pessimistic about the general economy, followed by the manufacturing sector, where a net 16.9% were pessimistic, and construction with a net 3.4% being pessimistic. The services sector was the most upbeat, with a net 10.1% optimistic, followed by retail with a net 6.8% optimistic. Sentiment in Canterbury was either flat or negative as the positive effects from earthquake rebuilding activity and agriculture waned, according to the ANZ. Still, overall inflation expectations increased for the year ahead, lifting to 1.7% from 1.6% and marking the first gain since October last year.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
And now a Kathmandu update. Kathmandu's shares soared to a 4-month high after Briscoe Group acquired a 19.9% stake and said it plans to make a full takeover, raising the prospect that Managing Director Rod Duke could use his skills to revive the struggling outdoor equipment and clothing chain. Kathmandu stock rose as much as 29% to $1.80, the price Briscoe paid institutions for most of the holding, and recently traded at $1.74. Briscoe built its stake without contacting the target company, and Kathmandu said it wouldn't comment on the imminent cash and scrip offer. Mr. Duke owns about 80% of Briscoe, and under his leadership, the retailer's shares have climbed 130% in the past 5 years as he drove sales growth at his homeware and sports goods stores. Kathmandu stock has slipped about 15% in the same period and has dropped 45% in the past 12 months. In February, Kathmandu said Christmas and January trading had lagged behind expectations, driving the retailer to a first-half loss. A month earlier, the company appointed Xavier Simonet to replace Peter Helkett, who left in November after 8 years running the company. Matthew Goodson, Managing Director of Salt Funds Management, said Mr Duke has proved he can do an exceptional job. Kathmandu clearly has some challenges, and it will be very interesting to see if his expertise in a slightly different but similar part of retailing can be successfully translated across. A lot of people would back him. Kathmandu posted a $1.8 million loss in its first half compared to a profit of $11.4 million a year earlier. Its gross margin shrank to 59.3% from 63.9%, with the most marked deterioration in Australia. Sales rose as the company aggressively discounted stock. An acting chief executive, Mark Todd, said in March that the company, which has 157 outlets, was slowing its pace of new store openings and that its full-year performance was dependent on favourable Easter and winter sales. Briscoe quietly built a 4.99% stake of Kathmandu before buying 14.9% of the retailer from institutional investors for $180 a share. That amounts to about a 29% premium to Kathmandu's closing price yesterday. Some 31 million shares changed hands today, the biggest one-day volume since former owners Goldman Sachs, JB Ware and Quadrant Private Equity took the company public in 2009, selling their entire interest. The Kathmandu brand was originally built up by founder Jan Cameron. Mr Duke said in a statement, "I'm excited by the potential that would arise from bringing together these two iconic retailers. We each have strong and recognisable brands that I see as complementary. The full takeover offer would consist of cash and shares." Briscoe said it wouldn't comment further on its plans. The operator of the Briscoe homeware stores and Rebel Sports outlets was the subject of market speculation in January that it was looking at a bid for struggling childswear retailer Pumpkin Patch. As at January 25, Briscoe had $89.7 million of cash and bank balances available. In market news, Xero has inked a partnership with cloud storage leader Dropbox, continuing a trend of recent tie-ups with A-list outfits. Chief Executive Rod Drury told NBR Radio, "We set out to build our brand in new markets by partnering with well-known brands, especially where by working together we can make better products for our customers." Over the past few months, we've announced technical partnerships with Bill.com, Avalara, Mindbody and Apple. Xero also recently signed a partnership with Google that will let its customers create invoices and quotes from within Gmail. A lot of such industry partnership announcements are drivel, at least from the shareholder perspective, because the lead company concerned is hooking up with all comers. But as with its recent Apple Store alliance, Xero has category exclusivity with its Dropbox deal. No other accounting software company is on board, at least for the foreseeable future. Dropbox's Australia-New Zealand manager Charlie Wood won't totally rule out working with Xero rivals like MYOB, but there is nothing on the table. He says the cloud-only Xero was the most natural fit. The partnership will allow Dropbox users to share documents directly from their personal or business accounts with a Xero account. Dropbox will also be a major sponsor of Xero's XeroCon conference in Melbourne in August. Dropbox claims 400 million registered users worldwide. Mr Wood says in Australasia it has more than 8 million. In crowdfunding news, the capital raised for Lance Wiggs' Puna Kaiki Fund has been extended as investments are juggled to get around the $2 million maximum raise allowed under equity crowdfunding laws. Although the snowball effect capital raise for the investment fund reached its $2 million maximum yesterday, it's been extended until Friday, along with the concurrent offers running to existing shareholders and private investors. Those who qualify for a private investor offer will be asked whether they will move their snowball investment over, opening up capacity for more investors to join the snowball offer. Mr Wiggs says $150,000 has been moved today, with a potential for another $150,000 to be moved before Friday, depending on how demand goes. He said, "We're very happy with where we are, but thought we'd give people a little more opportunity. Typically, you have a handful of large investors and a long tail of small investors, so it was easy to identify who might qualify for private investment." Mr Wiggs says one investor had invested in the snowball offer as well as private offer, which made moving that investment easy. To qualify for the private offer, a person must be an exempt investor as defined under the FM Conduct Act, which includes wholesale investors, high net worth individuals, close business associates and relatives. The minimum investment for the private offer is $21,750, whereas for the Snowball offer, an existing shareholder offer, it's $1,450. Mr Wiggs says the combined offers are reaching $4 million, with $600,000 from the private offer and about $1.4 million from the option round, with scope for all those to increase. But is this legal? Well, the only other company to reach the $2 million crowdfunding maximum was wine company Vivo in March, and the year-old equity crowdfunding legislation does not cover the possibility of switching investments over to a private offer to increase crowdfunding capacity. A Financial Markets Authority spokeswoman says there are no defined steps set out in the regulations and legislation for this type of scenario. Depending on the circumstances, we would pay particular attention to whether the proposal is designed to circumvent the $2 million threshold for crowdfunding. She says the FMA would expect the provider to consult with them before considering doing this, but would not disclose whether Punakaiki or Snowball had been in touch. The $2 million maximum is currently a healthy limit, but in the longer term, Mr Wiggs would like the FMA to consider extending it. He said it minimises the risk of people losing money when the limit is not too high. There are one or two equity crowdfunding offers that have gone through that I would say would be highly unlikely to meet their targets, so what happens when the fallout occurs? He said everyone is still learning how equity crowdfunding works, but in a year or two from now, a review should be done and the maximum raise amount should be on the table to look at. The FMA spokeswoman says changing the limits would require changing the legislation, and it's important to set limits to establish a level of protection for investors in this lower compliance regime.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
NBR Radio, Tuesday the 30th of June. I'm Andrew Patterson and this is Property Talk. With me, Chris Hutching and Sally Lindsay. Welcome to you both. Chris, to you first. The Fletcher building price, share price, might be somewhat out of alignment with the bullish presentations happening at the moment.
Yes, the price has sort of eased off. It's been easing off for the last few weeks and months, actually. And about 2 weeks ago, the executives from Fletcher's did a bit of a presentation in Brisbane where they outlined the pipeline of work, which is, good. It's a very strong pipeline of work, and a lot of it's got to do with developing housing in Auckland, actually, which is probably good for Auckland as well. So this briefing tells us that there's a lot of work on, but of course, translating that work into profits, etc., is another matter. I won't go through all of the projects they've got, except to say that a large number of them are based in and around Auckland and involve some high-profile sites like Hobsonville and Peninsula Golf Course, places like that, and a few in Christchurch as well. They also have a bit of an asset sales program underway, and I think this is mainly targeted at some of the more troublesome Australian assets, because remember, Australia has been through its own commodities downturn in terms of its mining, and I think this is probably where Fletcher's is coming under trouble. So they're having a look at the sale of some of those subsidiaries over there. And at this stage, they're probably not helped by what's going on in Greece, which is a sentiment that's just affecting all stocks.
Absolutely. It is interesting, actually, that the Fletcher price seems to have been very out of favour with the market for some time, as you say, despite the fact that they are possibly one of the busiest construction outfits in the country right now.
Yes, well, if I have a look at the stock exchange share price there, they were up to about 870, I think, if I can read this graph correctly, and they've just slowly sort of eased off since beginning of June, and they're back down now to about 8. So it's not massive, but pretty significant, and I guess the share price tells the story when it comes to confidence.
Indeed. All right, Sally, to you, this interesting headline, public transport subsidies and protester at work. This is Penny Bright.
Yes, Penny Bright. She's a well-known protester in Auckland, and in fact Auckland Council is chasing her and trying to sell her house from under her to get their hands on her unpaid rates. But anyway, she keeps on going, and she turned up at the council meeting last Thursday, which was to pass their budget, which passed by only one vote. But she was given speaking rights for 5 minutes, so she's asked the council for reams of information on the subsidies given by Auckland Transport to private transport operators which operate most of the public transport in Auckland. Auckland Transport doesn't really operate any of its own and relies on the public companies to provide it, and they give it subsidies. And as she says, they've put a transport levy on all Aucklanders to help pay for the transport projects the council wants, but they have given no information to the public on what subsidies there are, how they are arrived at, what they are there any rules in place for conflict of interest and all that sort of stuff. And as she says, this is work the council should be doing, but she's actually doing it on their behalf.
She's pretty tenacious, isn't she? I mean, she doesn't give up. No,
she's very tenacious, and she rings up reporters constantly and talks about all sorts of things. But in this case, she's right. People should know this information. And in fact, the council should have had this information before they imposed a transport levy, which the mayor, in his wisdom and as an executive sort of chairman of the council, dropped on councillors about a minute before the budget discussions finished. So it was sort of put on people without any consultation whatsoever. And she's thinks that there should be more discussion about it, and I'm sure there will be, because I'm sure their councillors will bring back an amendment to the budget and the long-term plan, even though it was passed last week.
You know, it's great to have these people around, isn't it? We've got a couple that I can think of in the South Island, and one in Dunedin who's been banging on about the stadium down there, and we have one in Canterbury here who's terribly dedicated in dealing with water issues and putting in submissions and things to every plan you can think of. And, you know, some people might say they're a bit obsessed. Well, perhaps, but they bring up a lot of things, and they are really a dose of fresh air to all the secretive goings-on that happen in most councils.
Yeah, and previously, of course, there was a much higher level of public engagement in this sort of thing, but in many ways, it's dropped away, and you're left with a few individuals who effectively choose to represent effectively all the others who almost can't be bothered.
Yes,
indeed, and where they get the energy from is beyond me.
Yeah.
Well, it seems to be Penny Bright's life's work to delve into the council's goings-on and their expenditure, but it was sort of quite noticeable that while she was sitting at the council table and talking, most of the councillors wouldn't even look at her. The mayor did, because he actually talked to her afterwards and said that actually she wanted reams and reams and reams of information, and was there any other way the council could give it to her, because they seemed quite put out that they would have to supply this information, and they've asked for an extension, or Auckland Transport's asked for an extension of time. But really, this sort of information should be readily available.
Yeah, you'd think in a perhaps more easier format that doesn't require the reams and reams of paper in the first place. Chris, to you, Aussie parallels with the Kiwi market. This is suggestions that really the Auckland and the Sydney markets are almost in perfect alignment at the moment.
Yes, I think the Sydney market's a wee bit more overpriced in terms of housing affordability than Auckland, but they're pretty similar. They're up around some crazy level, like 7 to 9 times average household earnings or something. Anyway, one of our funds managers, a guy called Shane Solly from Harbour Asset Management, he popped across to Sydney there for a meeting with the government agencies who talked about the state of the market there, and they've got the same sort of volatility that we've got, with average Sydney prices zooming up about 20% over the past couple of years, a little bit like Auckland, and residential consents are at an all-time high. So the state governments over there are trying to think of the same kinds of solutions that our Reserve Bank has brought up, aiming certain taxes specifically at certain cities, Sydney in particular anyway, because like New Zealand, Sydney is the leading house inflation capital, just like Auckland is here, but a lot of the rest of the country is not experiencing quite the same at all. For example, in Christchurch, prices seem to be easing off a little bit. We're seeing this first in the rental market. Now, the same thing's occurring apparently in Melbourne, where new supply of houses, new houses being built, is starting to have the desired effect, and the price rises are slowing, if not falling. I don't know that it's realistic to say that they're falling anywhere, but they're certainly not rising to the same degree. They are, however, falling in many rural areas, many provincial areas, as they are in New Zealand too. So we have this kind of disconnect, especially in looking at Australia, in Western Australia. House prices are actually declining because a lot of their big mining projects and such like are finishing or being cut back anyway with the demand from China going down. So it's having this sort of twin market effect, the same as in New Zealand.
The other thing you're noticing around Auckland is just the speed with which properties sell. You see the for sale sign go up, and then you see the sold notice on it literally, 10 or 12 days later.
Yeah, well, we all know the reasons behind that. We had such a massive immigration, 50,000 apparently, and I'd say that it's probably going to continue in Auckland for, well, it's just my guess anyway, for a year or two yet, depending, of course, on what the Greeks deliver.
Yeah, that's right. We're in the hands of the Greeks now.
And also what happens in China.
Yes, indeed.
Bit of both there. Sally, to you, the woman behind the country's second biggest class action. Who is she?
She's lawyer Adina Thorne. She's got her own company in Auckland, and she specialises in leaky housing claims. And she started off work about 10 years ago and became involved in a company that specialised in councils defending themselves against these leaky building claims. And she came across hundreds of people with terrible stories about how they'd done everything right to build or buy a home, still ended up with a leaky building. So after a few years of research and looking into this, she decided that the manufacturers of these claddings should be held to account, and it shouldn't be the builders, shouldn't be the councils, and therefore they're taking this class action. And they have got hundreds of people wanting to join it. 1,200 questionnaires have been sent out, and that's also to body corporates, which of course have got sort of 100 or 200 apartments under their control, and they feel that this is their last resort. So when she files in the court, which should be in the next couple of months, they'll have 100 million plus of claims, which the only other biggest class action in New Zealand is the Feltex claim, which is at 185 million, which is still ongoing, and also funded by the same litigation funder that she's going to be using. But she says it really is heart-wrenching to see all these people, that they've got a lifetime of debt. They cannot get out of it.
And their lives are almost effectively on hold, aren't they?
Yep. And she said a lot of people have managed to fix their buildings, but they're still they're still eligible to join this action. But she said there are a lot of people that can't do anything. They haven't got the money, haven't got the wherewithal, can't sue anybody, can't go anywhere. So it will be interesting because James Hardie will probably be the main manufacturer, and they will be lawyered up. But as she says, she will be too. And there's a case on in Canada at the moment against James Hardie, but I think it's not as big as this one, and it's not, and we don't know what's happening with that, but it's ongoing. So it seems like it's not a problem only in New Zealand. It's been a big problem in Canada, and I think it's even a problem in the States.
Absolutely.
These claddings.
It'll be certainly a case to follow with interest. Thank you both for joining us today, Sally Lindsay and Chris Hutching, our weekly property talk here on NBR Radio.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
Share markets around the world have slumped in reaction to the Greek financial crisis, but there are no signs of global panic. In the latest developments, the Greek government and European leaders have urged a yes vote in this weekend's referendum, which will decide whether the population will accept further austerity measures in return for continued bailouts. The left-wing government of Prime Minister Alexis Tsipras has indicated it will not meet a payment of €1.55 billion owed to the IMF and due today. In addition, Greece faces further debt payments of $2 billion on July 10 to bondholders and a further $454.3 million on July 13 to the IMF. The scale of this debt, the country's inability to pay, and the government's refusal to take measures demanded by lenders, who are mainly European Union governments, are behind the crisis. Greek banks are closed for the week. The share market is also closed. Controls have been imposed to prevent capital flight, and Greeks are limited to withdrawing €60 a day in cash withdrawals. Effectively, Greece has been let loose from international rescue loans for the first time in more than 5 years. Meanwhile, protest crowds in Athens are rallying for a no vote, which could mean a rejection of Greece's membership of the European Union and the Eurozone. This uncertainty, rather than the size of the Greek economy, is driving markets down. But the broader impact is limited because Greece is no longer so enmeshed in the region's financial system. Bonds in Italy, Spain and Portugal, highly indebted countries seen as vulnerable to shocks from Greece, weakened, though the moves were modest relative to the heavy sell-off seen during previous bouts of the crisis. However, Greek bonds have collapsed, with the 2-year yield soaring above 35%, a rise of nearly 15 percentage points. Let's talk power. The decline in foreign ownership of New Zealand equities and a looming decision on the future of the Tiwai Point smelter are depressing listed power company stocks. Over the past 2 months, Contact Energy share price fell 20% to $4.95, Meridian Energy fell 15%, Mighty River Power fell 12%, and Genesis 11%. One factor suppressing power stocks is foreign investors selling out of New Zealand equities as economic growth expectations weaken along with the New Zealand dollar. Nikko Asset Management Senior Portfolio Manager James Lindsay told NBR Radio, often when the New Zealand dollar is weak, foreigners look to dispose of their New Zealand dollar assets, which could be a potential reason for them reducing power stock positions. This, combined with Tiwai smelter uncertainty, may have triggered foreigners to review their positions. This is a big week for the sector, and there's enough going on to keep most people busy. A decision is due tomorrow on whether to keep running the Southland-based aluminium smelter owned by New Zealand Aluminium Smelters, but ultimately controlled by global metals giant Rio Tinto. The owners cut a deal 2 years ago with its electricity supplier Meridian and the government, which included a $30 million cash sweetener to save 800 smelter jobs, and gave Rio the option of exiting its New Zealand operation on more favourable terms than in the past. The renegotiated agreement, which covers 91% of the Tiwai smelter's maximum load and is equivalent to around 13% of the country's electricity demand, included a requirement for 18 months' notice from July 1st, 2015 for a full shutdown in January 2017 without penalty, or 12 months' notice if it decides after January 2017 to wind down operations. If it decides to give notice, then NZAS will either need to run the smelter unhedged to the electricity price, find another party that would enter into a similar contract, or close from January 2017. First New Zealand Capital expects the owners from tomorrow will become quite vocal and use public, political and commercial leverage to secure reduced electricity price, lower transmission costs or government support. Analysts are largely tipping Tiwai will remain open after Rio Tinto confirmed in March the smelter was again running profitably. And last week, the Electricity Authority published proposed changes to the way electricity transmission costs are allocated, which could deliver a $50 million a year windfall to the smelter and may be enough in itself to keep it operating. But weak aluminium prices, although partly offset by the weaker New Zealand dollar against the US, keep the outcome up in the air. Mr. Lindsay says whether Tiwai will remain open is the million-dollar question. Obviously, if you look at the aluminium market, it's been reasonably weak over the last few months, although fortunately the New Zealand dollar has also been weak. So there are pluses and minuses, and they balance each other out. Mr. Lindsay says if the owners do exit, there will be significant remediation costs to restore the site, and because the smelter uses roughly 12 to 13% of New Zealand's power, it will have a reasonably material impact on demand. Currently, he says, we're already oversupplied as far as capacity of generation goes, but that oversupply situation would be exacerbated more when demand falls by that 12% if Tiwai closes. That could be offset by some of the more expensive power plants closing. This includes closing Contact's gas-fired power plants and most likely closing further Genesis Energy's Rankine units at its Huntly coal-fired station. Genesis announced yesterday it's permanently retiring a second 250-megawatt coal and gas-fired Rankine unit from June 30, which did not surprise the market since Genesis had been making noises about closing it for the past couple of years. Other contributions to the power sector share price slump may be Labour's announcement last week that it's doing an in-depth sector review to form policy ahead of the 2018 general election, and Todd Corporation's plans for a new gas-powered electricity plant which could dampen wholesale prices.
NBR on Tuesday, the 30th of June. I'm Andrew Patterson, and talking Greece with me, Jason Walls. Jason, let's talk a little bit about developments in the last 24 hours because things are moving fairly quickly at the moment. Just bring us up to speed on developments over the last few hours.
Yes, well, it is basically D-Day for Greece. They've got until 9 a.m. tomorrow morning, and then that's when the debt cutoff jumps in. And so basically, as you said, in the last sort of 24 hours, we've seen markets around the world just going haywire. We've had the S&P and the Dow closed well lower than expected.
In fact, I think biggest drop for the Dow this year.
It's the biggest in the US. So it's a huge deal. I mean, it's worth noting in New Zealand, we haven't felt a huge impact. I think most market analysts in New Zealand kind of picked that it's not really going to affect New Zealand. It had a bit of a hit on Australia. But we've seen since the Alexis Tsipras announced that they would have the referendums on the 5th, which is next Sunday, there's been huge reactions because basically what he needed an extension from the creditors because, as I said, the bailout ends at tomorrow, 9 a.m. New Zealand time, and he wanted that extended. However, they just flat out said, no, you can't have that. However, it's sort of unclear what's happening in that area now. We know that they're going to default on Tuesday on 9 a.m. on New Zealand time on Wednesday if they don't come to an agreement with their creditors. They've been staunchly against everything that the creditors have thrown at them. So there's an impasse, and it looks like there's just nothing going to be happening in that sphere. So basically, we're just waiting for the default now. Yeah,
and that's been confirmed to CNN just in the last couple of hours that they will default. So we know that much. We know then, of course, there's this referendum. And what's interesting is that it seems the country seems more likely to vote yes than it is to vote no. Where does that going to leave the credibility of the Tsipras government?
Well, it depends which polls you're looking at, because I've seen ones that you rightly pointed out that some people are saying, yes, just accept the creditors. And some are saying at the same time, no, don't accept the creditors. And it's sort of like a bit of a contradiction in essence, because you've got the Tsipras government who were elected on an anti-austerity measure sort of ticket. And here they are asking their people who have voted them in on this ticket to say, well, actually, should we stick to our mandate or should we change it now? And it seems like they're just kind of buying time. It's a very, very desperate move. They're scrambling. In essence, they're just absolutely scrambling to just get more time, which hasn't been granted to them. But yeah, I mean, as you say, it's going to be a massive referendum. We've had people of Europe, the European Central Bank, you've got other key figures urging the people of Greece to say, yes, accept the reforms. And then you've got the Greek Prime Minister and his finance minister saying no, vote no, sort of thing. So it's all up in the air right now.
Very tricky if you end up with a split decision, if you end up with something like 50-50. I mean, what sort of mandate does that give the government?
I can't even imagine what would happen if it was 50-50. I mean, they need clarity right now. Their leaders aren't leading. They're elected to make decisions on behalf of the people. That's essentially what a government is. And I think it's very almost poetically ironic that the birthplace of democracy, Greece, is seeing basically the mandate being given back to the people on this critical vote, which is going to decide the future. I'm not being dramatic here. It's going to decide the future of the Europe. You're going to have pre-Greece and post-Greece, and that's how the history books are going to remember this one.
And let's focus a little bit on that, because really it is a vote on the euro as such. I mean, this is what this referendum is now being called, arguably the most significant referendum since the euro currency itself was formed. Yep. But where does this leave all the other partners who are party to the euro?
Well, it's important to understand at this point that if it was just Greece by itself, it wouldn't be a massive issue. It would be sort of just like, oh, it's another country. I mean, we had Puerto Rico this week has come out with some huge, and I'll go into that in depth a little bit later on in the week, but just something like that, an isolated incident, it doesn't have huge effect on the world economy. However, since Greece is part of the Eurozone and it's showing signs of cracking now, that's the problem. Because if Greece leave, it's going to raise questions for the whole credibility of the euro. As you pointed out, it's about a fifth of world trade. It's a massive part of the global economy. And if Greece leaves, it throws so many spanners into the works.
Spain, France,
the pigs
Portugal,
countries, yeah. And the other thing is that if they do default, it's going to have huge implications on the euro and the eurozone. If they don't default, and for some reason the creditors just bow to the pressure tonight and say, we're going to give you the money that you need, we're going to give you a small bailout, that raises questions for the other countries. It's like, hang on a second, if they can get away...
Moral hazard.
Yeah, if they can get away with holding an entire continent central bank and other creditors to ransom because they know that they're not going to want them to default, what's stopping Spain? What's stopping Portugal? What's stopping some of the other countries from saying, well, why do we have to adopt these austerity measures? Why can't we just do whatever we want?
All right. Now, the other part of this that has gone quiet in the last week or 10 days was this suggestion that Russia would ride to the rescue of Greece, but things seem to have gone very quiet there. What's happening on that front?
Well, you kind of get this idea of like Vladimir Putin riding on a horse and saving the Greek people, and I think that a lot of I saw a cartoon a while back of that exact thing happening. But what the concern is right now for Angela Merkel and other people in Europe is that they've had Russia waiting on the doorsteps of Europe for so long. That if the Greeks decide to default, then the Russians could sweep in and say, hey, we can help you out. We can make sure that your people don't riot. We can make sure that everything's going to be okay. And Merkel doesn't want that. She doesn't want Russia to gain more of a foothold within Europe. And this is a prime opportunity for Russia to swoop in and establish that foothold. So it's very nerve-wracking for people. And that's another reason why they've just kept I talked to Oliver Hartwich a while back, and he said just keep kicking the can down the road, because that's one of the big concerns is Russia coming in and just kind of being this white knight for the Greeks.
So we will follow developments in the coming days with interest. A very fluid situation and not looking like it's going to be resolved easily anytime soon. Thanks for joining us, Jason Walls, with us here on NBR Radio.
NBR Radio. Free to air online with business news you can use.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. SmartPay poised for Oz taxi market. Kathmandu shares soar after takeover offer, and the new boss of Kathmandu has only been in the seat for a week. What must he be thinking? Business confidence turns negative, building consents static, and Punakaiki gets around crowdfunding rules. To find out more on our stories, just log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. To the Christchurch Convention Centre. The delay in the government's promised convention centre for Christchurch is in deference to the $600 million expansion and rebuild of the city's hospital facilities. Our reliable NBR NZPI sources confirmed the reasons given to property managers at a meeting of state sector property managers in Christchurch a few weeks ago. The property managers were told the delay was to ensure the most competitive pricing for one project at a time. Put another way, it's better to have 10 bees or construction firms buzzing around one honeypot, the hospital rebuild, than having 10 bees hovering around 3 honeypots. According to this explanation, putting out major projects for tender one at a time means firms will compete more sharply with each other, keeping prices constrained. In any case, the delays will ensure a longer pipeline of work if the convention centre goes ahead at all or in its original design. The government has already spent $77 million buying the land for the centre and more than $7 million on design fees. Work on the convention centre was scheduled to be underway in late 2014 with completion near the end of 2017, according to the Prime Minister John Key when he launched the rebuild blueprint at a gala function in mid-2012. In response to numerous media inquiries, Canterbury Earthquake Recovery Minister Jerry Brownlee says the centre is unlikely to be completed by the end of 2018. Neither Mr Key nor Mr Brownlee will explain the delays or discuss intentions. 3 years ago, the price of the convention centre was calculated at $284 million to be paid by the government, but details about operating costs and ownership have never been determined. In response to an Official Information Act request for the business case at the beginning of 2013, the Canterbury Earthquake Recovery Authority provided hundreds of redacted pages of reports. The Ombudsman is still working through a complaints process 2.5 years later. In market news, the ACCC, that's the Aussie equivalent of our Commerce Commission, put a bomb under the taxi charge industry across the ditch yesterday. A landmark ruling says cab charge, which dominates the Australian market, must allow rivals cards to be used on its taxi terminals. Challengers, which since December have included NZX-listed SmartPay, have been unable to negotiate access. Managing Director Bradley Gertis told NBR last night it's good news for the Australian taxi market and consumers in general. It'll promote competition and it comes at a good time for SmartPay. The Managing Director says most of SmartPay's revenue comes from its taxi and bank business in New Zealand. Its plan to grow revenue and profit is centred on expansion across the ditch. There is still work to do. Mr Geddes says SmartPay will have to adapt to cab charges terminals, but the development work is within our capabilities. We haven't seen their spec, but we write to different specifications all the time. It's our bread and butter. Until December, SmartPay partnered with cab charge rival Live Taxi ePay, supplying half of Live Taxi's 15,000 payment terminals. After a bad-tempered breakup, the pair is now tussling in the New South Wales Supreme Court, with Live Taxi ePay claiming it's owed compensation for terminal breakdowns. Mr Gertis refused to comment on the case beyond pointing NBR to a market filing noting SmartPay's counterclaim that it's owed 600,000 Australian by Live Taxi and is confident of a win. In market news, the Commerce Commission has confirmed Wellington International Airport's revised landing fees mean the gateway's returns fall within an acceptable range. The airport company, owned by Wellington City Council and Infratil, revised its landing fees after the Commission previously found it was targeting excessive profits. The regulator said in a statement, as noted in the draft report released in April, the Commission's analysis estimates WIAL has set its prices targeting a return of 8.4%, which is just within the upper limit of an acceptable range of 7.4 to 8.4. The period covered by the review is June 1st, 2014 to March 31st, 2019. Deputy Commissioner Sue Begg said, "We estimate that consumers will now be 33 million better off over a 3-year period as a result of this process." In its May submission on the Commission's draft report, the Board of Airline Representatives New Zealand, or BARNZ, the lobby group for airlines, noted that the airport company had made significant adjustments by applying the regulator's input methodologies for asset valuations. BARNZ said, however, for the airfield cost centre, significant differences still remained. It said the differences arise from a situation of natural monopoly where there are still material issues which information disclosure has to date proved insufficient to address, and where WIAL is misusing its market power to impose on airlines an outcome that does not reflect likely outcomes in workably competitive markets. Wellington, Auckland International Airport and Christchurch International Airport are required to disclose their pricing methodology under Part 4 of the Commerce Act. The latest round is the third under the Part 4 rules. The Commission said its final report doesn't include analysis of the airport's proposed $300 million runway extension because the company didn't include that in the latest price-setting event. Infratil shares last traded at $3.11 and have gained 5.7% so far this year.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
NBR Radio, Tuesday the 30th of June. I'm Andrew Patterson. The world's eyes are on Greece as it struggles to repay debt and avoid financial collapse. In his editor's insight today, Neville Gibson says a different kind of trouble is brewing in China. That could be just as dramatic. Neville, China's share market is looking like a bubble that's burst.
It sure is. The market there has become the most volatile in the world, even including Greece, and given that it's one of the world's 2 largest economies, investors have a real right to be wary. The main stock index, it's the Shanghai Composite, entered bear market territory as recently as Friday. That's a 20% drop in value, and it's gone down a further 2% since he reached its high on June 12. So that was despite a move over the weekend by the authorities there to cut interest rates and hopefully lift the market, but it hasn't worked.
In fact, what's interesting about the move in the last couple of weeks is that it has wiped out all of the Shanghai Composites gains in a year. It wiped them all out in 2 weeks.
That's right, and there's been a huge speculative bubble that's been going on there, and it's been fueled by a couple of things. One is the rise in margin lending, something that I hope nobody indulges in, where investors borrow money to buy stocks in the hoping that they can repay their debt, make a profit as the prices rise. And the borrowing of this alone was estimated last week at mostly around about $240 billion US. That's phenomenal. The other cause is that the authorities themselves have been fueling investment in the share market as a way of boosting the slowing economy there. A lot of new listings raise capital for businesses, that's fair enough, but a lot of these companies have then taken the opportunity to borrow even more. So when you combine that with margin lending, you've really got a lot of risks running in that bull market, which appears to be over at this stage.
I saw a piece on CNBC recently. All of the rural farmers that would normally be on their tractors, the tractors were all parked up outside a shop, and they were all gathered round the terminal playing the share market. You kind of get worried when you see that, Neville.
When the Chinese farmers take over from the boot polishers in Wall Street.
That's right. We know how this game plays out. How large is this debt problem in China?
Well, the problem in China is it's not a very transparent country when it comes to things financial, and the debt is certainly not confined to those share speculators. You've got property developers, local government, even the state-owned enterprises are all heavily in debt. McKinsey Global Institute put out a report that said that this borrowing was around about 280% of GDP in 2014, so that's a wee while ago, and that's really high for a developing economy, and it's putting a lot of questions against the health of the Chinese economy, as it also, to reverse their economic decline, they also are encouraging further debt. So even though the rulers in China are trying to get more consumption to rebalance the economy, it seems that this is quite a dangerous bubble.
There's also been a move that is holding out foreign investors.
That's right. Certainly getting foreign investors in the market is part of the Chinese plan, but MCSI, which is a world index of stocks, have again rejected the emission of China's A shares. These are the ones that are available to foreigners. They're denominated in yuan, and they're listed in either Shanghai or Shenzhen. MCSI says that these are on track for inclusion, but it adds the rider that a few important issues remain relating to accessibility. And the head of the Asia-Pacific operation of the company this week told the Wall Street Journal that these involve the capacity to freely buy and sell security, complete transactions in a timely manner, and give clear title to the shares. So there's a lot of large international funds that won't go into the market until these issues are resolved. And the problem there is that the share regulator has about 7 or 8 other government agencies that must coordinate to get these measures across the line.
They might be staying away a little bit until this volatility settles down a bit. But what do you think can be done about the debt problem in China?
Well, apart from the size of it, which is probably a lot of guesswork on the part of Westerners, it's also pretty reminiscent of what went on in the Asian financial crisis in 1997 with Korea, Indonesia and Thailand. That had huge repercussions. The Chinese authorities, of course, are more in control of their economies than those countries were, and they're well aware of the problems, but they are trying to organise that some of these over-borrowed provincial governments can be bailed out. One measure is that the state-owned banks, which lie in the middle of the provincial ones and the central bank, are allowed to buy thick end of $400 billion worth of bonds, and these are being swapped by those provincial banks in exchange for money that to cover those reserves. A similar type of recapitalisation program went on in the 1990s in China as growth there took off, and a whole lot of bad loans were warehoused or forgotten about. No one was punished in that process, and now it looks like it's being repeated. Other moves taken by the central bank are to cut interest rates, as happened over the weekend, bring more liquidity to the market following the policy of the US Federal Reserve, and also cut deposit rates and that sort of thing to near zero. So who knows where it'll all end up.
Indeed. Thanks for joining us, Neville Gibson, with us here on NBR Radio.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
In politics, the Greens just can't decide whether the harmful digital communications bill is a defence against cyberbullying or an attack on free speech. So the party is allowing a split vote in today's third reading of the legislation, some voting against it and some will back it. The legislation has thrown up some interesting debates and alliances, with ACT's David Seymour also speaking out against it. Green Party co-leader Maturia Ture said in a statement, most of the Green Party caucus is supporting the harmful digital communications bill due to our concern for New Zealanders' rights to personal security and the right to be safe from cyberbullying. This legislation has received strong support from organisations such as the Human Rights Commission. However, there have been strong submissions from media organisations who are concerned that this legislation may have a chilling effect upon freedom of speech. While a relatively rare occurrence, there is provision for split voting in the Green Party caucus on various pieces of legislation. We were relaxed about allowing members of the caucus who felt very strongly about the freedom of speech issues relating to the bill to oppose this legislation at the final reading. However, the majority of caucus were concerned that there is currently a gap in the legislation enabling cyberbullying and harassment to go unchallenged. All members of the Green Party will be keeping a close eye on this legislation to make sure that its implementation does not have a chilling effect on New Zealanders' use of the internet and freedom to speak their minds. In People News, Xero, the cloud-based accounting software developer, has appointed Virgin Australia executive Sankar Narayan as its next Chief Financial Officer. Mr. Narayan will join the Wellington-based company from October and will be responsible for Xero's global financial and administrative functions and strategy, according to the firm. Mr. Narayan has previously been CFO at Malaysia's satellite pay TV service Astro, ASX-listed publisher Fairfax Media and Australian pay TV firm Foxtel. Chief Executive Rod Drury says, we've known Sankar for many years and appreciated his advice during the early years of Xero. He brings a wealth of global financial experience in businesses that operate at scale in fiercely competitive markets. Xero changed its recruitment tactics for senior executives earlier this year after the departure of two senior managers who weren't the right fit with the company. Mr. Narayan's experience includes merger and acquisition activity, initial public offering preparation, and public and private capital raisings in global markets. In February, Mr. Drury said he would like to list Xero on the NASDAQ over the next 12 months as it puts greater focus on making inroads to the US market. In March, the company crossed the halfway mark to its 1 million customer target. Xero shares last traded at $18.05 and have gained 12% this year.
Tuesday the 30th of June on NBR Radio, I'm Andrew Patterson, and joining us now, Sydney-based analyst with Milford Asset Management, Victoria Harris. Victoria, the news that Briscoes is going to acquire Kathmandu, was this a surprise to the market?
Yeah, hi Andrew. Yeah, I think it did come across as a surprise. The Kathmandu has had a tough time of late. It's got no CEO currently, and it has had a few downgrades, so it is trading in a tough environment. So this is this bid by Briscoes at $1.80 per share is quite an opportunistic bid for the company in our view.
Does it value the company appropriately, do you think, or will they have to end up raising the offer? Is this the early start?
I think, like I said, I think it's pretty opportunistic, and I think that the Kathmandu will defend it strongly. This is a retailer that does kind of operate in cycles, and I think it's just going through a period of it's increased competition and rising costs from the currency. So I think that they will defend it strongly.
What's been the issue with Kathmandu? Because it did start off with reasonable promise, but is it just another example of a retailer that's caught up in an environment that's not particularly conducive to retailing at the moment?
Yes, well, the majority of its earnings do come from its Australian stores, and they have been, there's been increased competition again in Australia, and they're seeing the rising cost of goods due to the currency. So it is in a tough period, but like I said, it does operate in cycles. As we've seen with a few retailers. So it's just operating in that tough retail environment.
What do you think the combination with Briscoes will add to it? Because they do operate in very different spaces, from a retail perspective.
Yes, you're correct there. And but I mean, the Briscoes does have the Rebel Sport offering in New Zealand. So there will be some synergies over there with the kind of the active side of Kathmandu and the Rebel Sport. And I mean, Rod Duke, the CEO of Briscoes, is one of New Zealand's best retailers, in my opinion. So and he does have previous experience of running a trans-Tasman business. So he is a good operator, and will hopefully be able to get the benefits of those synergies across the kind of the Rebel brand and the Kathmandu, as well as across buying and sourcing benefits across the whole group.
And is it likely that he would leave it to continue to run as a standalone business?
There's been no discussion from Kathmandu or further discussion from Briscoe, so I'm unsure on that. But I would assume so. I mean, Kathmandu is quite a strong brand across both sides of the Tasman, and same with Briscoes and Rebel Sport. So in my opinion, it would be in the short term would be best to keep them trading under their strong brands.
And Briscoe shares rising 2% today, so clearly the investors, or shareholders rather, in Briscoes are reasonably welcoming of the move.
Yes, yeah. So that 2%, and obviously Kathmandu is up, over 20%. But yeah, I mean, it will create, as a group, a far more riskier business, adding that Kathmandu arm. So it is a positive for the group, as it does, create some liquidity, as Briscoes was a fairly illiquid stock to begin with. So I think that's why it has been taken positively by Briscoes shareholders. And
just finally, there were suggestions or speculation earlier in the year that Rod Duke may look at acquiring Pumpkin Patch, which of course, as we know, is in all sorts of trouble at the moment. Is that likely, do you think?
I can't really comment on that. I mean, I'm sure he's been asked by numerous investors, on the Briscoes and the Pumpkin Patch side of his intentions, but he is on the board there, so he does know that business, intimately. And he does look for value, and obviously he's kind of seen it in Kathmandu, but yeah, can't comment on his intentions in Pumpkin Patch.
Thank you for joining us today, Victoria Harris, Sydney-based analyst with Milford Asset Management on NBR Radio.
NBR Radio with Hotel de Brett, partying since 1959. www.hoteldebret.com. NBR Radio.
To the latest OIO approvals. Well, the latest draft of Overseas Investment Office approvals includes Carter Holt Harvey assets, mortgage securities, forests and vineyards. The Carter Holt approval is for NBR Rich Lister Graham Hart's planned share market float, which has been shelved in the meantime anyway. Soft market conditions in the face of the Greek crisis make it unlikely the float will take place in the near future, even though it technically now has the green light. The application to the OIO relates to the proposed initial public offering for the building supplies group owned by Carter Holt and related companies, involving more than 445 hectares in several locations around New Zealand. The IPO would result in the business being listed on both the NZX and ASX, with the listed entity becoming an overseas person, because overseas persons are expected to acquire 25% or more of the company through the IPO, according to the OIO report. The OIO says benefits would include additional roles at Carter Holt, opportunities for New Zealand retail and institutional investors, and the advancement of the building capital markets work stream of the New Zealand Government's business growth agenda. Meanwhile, Liberty New Zealand Warehouse Trust No. 1, owned by Sherman Ching Ma of the US, has OIO permission to acquire the business assets of Secure Funding, involving consideration of more than 100 million comprised loans and related securities originated by Secure Funding, the vendor of the assets. The owner of Secure Funding is also Sherman Ching Ma of the US. The OIO says the investment is a securitization transaction under which residential mortgage loans originated by the vendor will be acquired by the applicant trust, which will then be funded by a warehouse facility or on the capital markets. This will fund the vendor's future lending. In Marlborough near Blenheim, Vinpac International New Zealand, 98% Australian-owned, is buying land from Isabel Estate Partnership in receivership, whose shareholders are Michael and Robin Tiller. Vinpac is acquiring the great growing land for $8.6 million. A farm managed by My Farm, comprising the freehold interest in 2,583 hectares, at Raitahi, known as Tanupara Station, is being acquired by a Hong Kong-owned company called Tanupara Asia. The vendor is James Bull Holdings. The new owners intend to develop Tanupara Station to increase its carrying capacity, productivity and profitability, while modifying the operation to be more focused on sheep production. New Forest Limited, also owned by investors from Hong Kong, is buying business assets from the Hong Kong-based shareholders of Greenheart Group, which owns 12,500 hectares of freehold land at Mangakahia Forest Estate. The consideration is described by the OIO as up to $79.5 million US, of which $45 million is paid in Sino Capital Global Inc. And the Tiong family of Malaysia, which owns forestry giant Ernst Law 1, is buying 464 hectares in Waihopai, Marlborough. In People News, former National Party candidate and Manukau City Councillor Ken Yee has been struck off the roll of barristers and solicitors for misusing $600,000 of client funds. The New Zealand Lawyers and Conveyancers Disciplinary Tribunal says Mr Yee misused the money in two ways, resulting in misconduct clearly regarded as disgraceful or dishonourable. Mr Yee was found to have taken more than $500,000 from his law firm's trust account in a series of unauthorised loans to one of his own companies. The tribunal says the loans have all been repaid, but a further just under $100,000 in fees were also diverted to companies he was associated with, which is yet to be repaid. New Zealand Law Society National Prosecutions Manager Mark Treleaven says the misuse of funds held in the aptly named Solicitor's Trust account is totally unacceptable. He said the reputation of the legal profession stands on ensuring that a person can have absolute confidence that any such funds will be securely and safely held in trust by their lawyer. In 2005, Mr Yee was ranked at number 58 on the National Party's general election list and stood for the Manukau East electorate. He also served 2 terms as a Manukau City Councillor.
NBR Radio, Tuesday the 30th of June, and with me, Jason Walls. Jason, the government has signed this deal with China, the China-led Asian Infrastructure Investment Bank, and taxpayers contributing $125 million. What will this actually involve?
Well, first of all, I'll tell you a little bit about what the AIIB is. AIIB, yeah, too many I's. It's an investment bank led by China that looks to invest a lot into the Asia region. It's a region that's been identified by economists in various different reports and by people in various different capacities as an area that needs a lot of investment. There is huge opportunity for growth within Asia. In fact, I saw a really interesting analogy a couple of months ago where it was just a world map and it had a circle and said more people live in the circle than outside. And it was just amazing to see the amount of people that live in this area. But unfortunately, a lot of them haven't got access to even the basics such as clean drinking water and the basic infrastructure such as transport and electricity. So the bank looks to invest into this and helps to bring the economy up in the process, providing jobs. So New Zealand's context to this is we're going to be providing $125 million over 5 years. And so it does sound a lot when we're talking about it in New Zealand, but it's important to put that into context about what other countries around the world are contributing. You've got the likes of India, Germany that are contributing huge amounts of money, and then China, who are contributing about 30% of the $100 billion that will be in the fund.
So this is a consortium of countries that have come together to invest capital to drive long-term outcomes. What does New Zealand specifically get as a benefit?
Well, we enjoy the better economic conditions of other countries being able to help us. In my story, I talked to Bill English, and he was outlining to me that when other countries prosper economically, New Zealand stands to benefit if they're buying New Zealand goods. And for example, we export a lot of dairy. When countries become economically richer and more financially sustainable, they do things like they buy things like milk and other things that we export, things that they've been focusing on just keeping them alive for a long time. When they lift themselves out of poverty, they move into an income bracket where they can start looking at more things that they enjoy more, such as milk. It's not a luxury good, but when emerging economies come out and start buying things, it's things like milk and meat and things like that that really benefit. And New Zealand is set to really enjoy a lot of the returns.
Perhaps not surprisingly, this move doesn't come with the sign-off from the US, who have warned countries to think twice about joining the bank, citing particularly its lack of transparency. So there are some risks potentially here.
Yeah, there are risks. And, I mean, when you have a huge deal like this going on, there's always risks, then there's always critics. And unusually with the Asian Infrastructure Investment Bank, it is the US that have been very critical about it. And they've been a staunch holdout from the beginning. They cite issues around transparency. They say that people shouldn't be too quick to jump in this boat. It's basically, at this stage, it's only the US, Japan, and most of Africa, and there are a few other countries as well that haven't got involved. But it's been the source of a lot of friction.
Stephen Jacoby, the Executive Director of New Zealand's National Business Forum, of course, notes that New Zealand is actually one of the few countries that has good relations with both China and the US, but he warns, quote, when elephants fight, it gets tough for the guys in the grass, unquote.
Yeah. For a journalist, a quote like that is gold, isn't it? It just sounds fantastic. It'd be even better for you radio guys getting a soundbite like that. But he's absolutely right. Like, New Zealand has one of the best relationships with China in the world. We were the first country to sign a free trade agreement with China back in 2008. And since then, the Chinese president, or premier, has visited New Zealand a couple of times. And because of that, we've just seen repeatedly how strong our relationship is. And in the past, the Chinese president has actually talked about how good our relationship is with China, how good the Chinese relationship is with New Zealand. And he cited it as something that he would want to see continuing with other countries. And, of course, New Zealand gets along well with the US as well, although Mr. Obama hasn't graced our shores yet, and I don't think he will. But we're in a very unique position where we actually see eye to eye with both of the major superpowers.
And just finally, does this effectively create competition for the World Bank?
Yeah, that's one of the things that they've been citing as well. I mean, a lot of people say that they can coexist peacefully. You've got things like the IMF and the World Bank that, as the names would suggest, they're international and they deal with the world. But the Asian Infrastructure Investment Bank deals with Asia, as well, the name would suggest. So it's broadly looking at a specific area. I know it sounds like a bit of a contradiction, but Asia is quite big, and the needs are huge, whereas the IMF is still going to be working in places like Africa, Southeast Asia, and, of course, Greece, which we've heard a lot about today.
So there's plenty to go around. Thank you for joining us, Jason Walls, on NBR Radio.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
In company news, several Milford asset management funds are invested in beleaguered Australian law firm Slater & Gordon, whose share price dropped 25% yesterday after it said errors had been uncovered in the financial reporting of historical cash flow at its UK business. The ASX-listed law firm is in the middle of a $1.3 billion Australian dollar acquisition of UK-based Quindell plc, whose shares were suspended last week as regulators launched an investigation into that company's accounting. The Australian Securities and Investment Commission is also investigating Slater & Gordon's relationship with Melbourne-based auditor Pitcher Partners. Former Australian Prime Minister Julia Gillard worked for Slater & Gordon in the 1980s before moving into politics. It's perhaps best known in New Zealand for joining in the class action against New Zealand's major banks over fees. Milford Asset Management has 3 funds invested in the law firm, with its Milford Dynamic Fund holding a 7.4% stake and its Trans-Tasman Fund holding 1.4%. Slater & Gordon is also the biggest Australian investment for its Active Growth Fund, which has a 2.9% stake, and investors were told in a June portfolio update that the investment had made a negative 5% return for the month following a major capital raising to fund its acquisition of Quindell plc. Milford Executive Director Brian Gaynor said the investment in Slater & Gordon was now under review and the firm had always known it was high risk. He said, "We have a portfolio of over 100 stocks and some are more high risk than others. Slater & Gordon is higher risk and we've done very well to date out of it, but there will always be winners and losers." Mr. Gaynor said it was difficult to know exactly what was going on with the law firm investigation because the regulator doesn't provide full information on its inquiries. He said, "We're still pretty confident that this is something the company will get over, but we don't really know yet." Slater & Gordon's 2007 IPO on the ASX was a world first for a traditional legal entity. In an April commentary to fund investors, Milford portfolio manager William Curtain said when Slater & Gordon completes the acquisition of Quindel's professional services division, it will become the UK's largest personal injury law firm and jump into the ASX 100 with a market value of more than $2.5 billion. The Australian Financial Review reported today that it wasn't a good look when a global law firm that profits off the mistakes of other corporates and relies on a reputation for accuracy admits to accounting errors stretching back several years. The mistakes, blamed on a spreadsheet error, don't have an impact on its UK division's actual net cash results and related to the way receipts from customers and payments to suppliers were reported. And now a warning from the Commerce Commission. The Commerce Commission is warning startups and small businesses to be aware of an organisation called New Zealand Small Business Assistance Centre, or NZSBAC, that's offering access to government grants at www.nzfundinggrants.org. NZSBAC is not part of or connected to the New Zealand government, despite the website giving some people the impression that it is, according to the regulator. The Commission has received more than 100 complaints from dissatisfied customers who say that they were misled about their business's eligibility for New Zealand government funding. Consumer Manager Stuart Wallace says some complainants have told the Commission that after contacting NZSBAC by phone to seek government funds to help establish or grow their small business, they were told that they were eligible for government grants or funding up to a particular amount. After making a credit card payment, a link to a database of New Zealand government agencies offering grants or funding is received. While some may be eligible for government grants from agencies on the database, many have then found they are either not eligible or not eligible to the extent represented by NZSBAC. Mr Wallace says despite NZSBAC's website showing an Auckland address, there is no evidence it's located in New Zealand. The Commission believes it's based overseas and may be associated with a company in Canada. Mr Wallace says similar websites appear to be targeting citizens in other countries and have come to the attention of regulatory authorities in Australia and elsewhere. A number of individuals who were featured in success stories on the website were contacted by the Commission. They say that their videos have been used without their permission. While they did obtain government funding, it was not with the assistance of NZSBAC. Mr Wallace said information about government funding and grants is typically available for free in New Zealand. He said we encourage those seeking business funding and grants to visit official government websites such as business.govt.nz. Mr Wallace said, as NZSBAC is not based in New Zealand, the Commission is limited in what investigation and enforcement action we can take. We have liaised with overseas authorities over the complaints received, and we're currently looking at other options to protect consumers from being misled by them. NZSBAC was formerly known as New Zealand Business Funding Centre and featured on Fair Go in 2013. Let's talk TPP. According to Trade Minister Tim Grosser, negotiations for the Trans-Pacific Partnership will accelerate in July, with New Zealand officials working to stitch up a deal by the month's end. With US legislators granting President Barack Obama's administration fast-track approval, Mr Grosser expects the 12 nations negotiators will put their real cards on the table after several years of shadowboxing. The US Senate and House of Representatives this month affirmed Trade Promotion Authority, or fast-track authority, meaning the President can take a trade deal to Congress for a so-called up or down vote, which can only accept or reject the deal, not alter it. Unless US policymakers approve TPA, Japan and Canada wouldn't back a final deal. Mr Grosser said in a speech to the US-New Zealand Partnership Forum in Auckland, "Now that Congress has spoken, it is showtime. I've learned never to be dogmatic about timetables, but the scenario that I and my negotiators are working to is that we have to get the basic political deal done by the end of July, including finalising all the chapter texts, leaving only legal rectification by experts to be done thereafter." Mr Grosser said a successfully completed deal won't be perfect, but that he and his officials have told Prime Minister John Key and other ministers that there is potentially a landing zone for a good deal that will indeed shape the future of trade and investment integration in the Asia-Pacific region, and quite decisively. Mr Grosser said the lack of clarity over dairy, New Zealand's biggest export commodity, will change because it has to change. If dairy were excluded from the TPP, New Zealand would walk away, he said. The TPP agreement seeks a trade agreement spanning the Pacific Rim and currently involves 12 countries: New Zealand, Australia, the US, Canada, Japan, Singapore, Malaysia, Brunei, Vietnam, Chile, Peru and Mexico. Where the deal differs from other free trade agreements is that it includes alignment of regulatory settings across borders rather than simply removing quotas and tariffs. It's faced staunch opposition from those who claim it undermines national sovereignty through investor-state dispute settlement provisions and through its treatment of intellectual property and medical procurement. Mr Grosser again defended New Zealand's negotiating position, saying he wouldn't sign up to poorly constructed ISDS provisions that transfer control of the country's sovereignty to foreign corporations or undermine a central pillar of our public health system, the pharmaceutical agency called Pharmac, or prevent future governments from implementing well-designed environmental protections. He said if and when we get TPP in place, extreme claims that the sky is going to fall in will be made, irrespective of a balanced and sober reading of the final agreed TPP texts. Mr Grosser also scotched speculation that the agreement was part of the US plan to contain the emerging Chinese superpower and said China could potentially sign up to a later iteration of the TPP.
NBR. Need to hire? Try our online recruitment platform www.nbrtalent.co.nz.
NBR Radio, Tuesday the 30th of June. I'm Andrew Patterson. Welcome to Ask Me Anything. And joining us today, E-Road founder and director Steve Newman. Steve, welcome. Talking about the company and some of the questions put to you from the NBR audience. First up from Chris Keel, E-Road recently reported it had around 155 staff in Auckland, in its Auckland office, and another 20 or so overseas, and that recruiting efforts are complicated by the ICT skills shortage. How many staff are you looking to hire over the next 12 months?
So the staff that we're going to hire over the next 12 months really falls into, I suppose, two camps. One is around the ICT side of things in terms of developers and engineers, and the other side of it is sales and go-to-market staff in the different markets that we operate. In terms of likely headcount, I think we will be around the 200 mark.
And that is across the board in terms of those different roles?
Yes, I think the main headcount growth over the next period of time is going to be sales resource and order fulfillment, customer service people, particularly in North America.
So how are you combating the skills shortage?
So we have a number of strategies. Certainly the success of tech companies in New Zealand is putting a lot of pressure on New Zealand-based staff. We've made a decision to keep our engineering teams in New Zealand, so it's about recruiting and getting those people to New Zealand from offshore, and also to look at getting more involved with the universities and mentoring and bringing graduates into the business.
You've also been paying sign-on bonuses too, up to $15,000. How successful has that strategy been?
It was interesting because it was kind of successful, but not the success that you would expect it to be. I think it most probably doubled our velocity of hiring people and may have improved the quality a bit. But people are looking for more than just a sign-on bonus. They're looking to come to the right employer where they can get a better career. So we did that to fill a few critical roles. But certainly I think selling E-Road and what it can provide to developers and engineers in particular is most probably a better strategy.
And of course that presumably attracts interest, plenty of interest from offshore. What would be your proportion between offshore recruiting and onshore? The people that are offshore, there's a bunch of folks which have already made a decision that they're coming to New Zealand, so there's almost a third category. It's fair to say that E-Road very much looks like the United Nations, and certainly in the last 6 months, I think we've employed people from about 20 different countries. Indeed. Now, executive pay has been in the news recently. Do you think New Zealand executives are overpaid?
I would assume that the governance processes in those businesses are using the right companies to look at remuneration and would be guiding boards accordingly.
And if you look at your own annual report, you paid around $318,000 plus a $71,000 bonus for 2015. That seems pretty modest compared to other New Zealand tech companies.
I think it is most probably reflective of where we've been as opposed to where we're going. But
you're comfortable with it?
Absolutely.
Right. All right. From JK, he says, congratulations on eRoad's success so far. I take a keen interest in following the journeys of young New Zealand companies. Where do you see eRoad in 10 years' time? And do you see yourself still playing a major part in the business that far down the track? And also, Jeffrey asks a similar question. Also asks you to talk a bit about what the actual size, I guess, of your global market.
Well, 10 years for a tech company is a long time. It's been a 7-year journey to get to where we've got to. Certainly in 10 years' time, I would like to think I'm still making a significant contribution, maybe not as the CEO. I think it's important that we keep bringing talent into that leadership team. I think the business will hopefully be, and I'm certain that it will be, a global leader in this GNSS tolling space that we operate, which, in less jargon, being a leader in transportation, tax and compliance. I would expect that we're still headquartered in New Zealand, and we'll be a $100 million business.
To a certain extent, is your growth limited by the willingness of governments around the world to adopt road user charges?
No, not at all. So, in terms of the road user charging solution we've rolled out in New Zealand and a similar weight mile tax solution in Oregon, that would be, I suppose, our starting point, but certainly our offer is now much wider to look at helping in the US companies to complete their taxation records with respect to the fuel tax. Mm-hmm. So we are providing aids for them to complete their record keeping. In terms of providing an end-to-end solution, we do need cooperation with government so we can connect to their systems for the electronic filing and payment. But there's a lot of value that we can deliver to customers without having those critical relationships with governments in the first instance.
So you see the opportunity effectively just to keep reinventing your product range or your offerings based on as the market effectively evolves and develops?
Correct. So if we look at North America, we started in Oregon with the weight mile tax, and that was a very close association with ODOT in order to, Oregon Department of Transport, to complete that, and that is a complete end-to-end solution. We then have started delivering on our fuel tax solution, which is in the 58 states and provinces of North America, excluding Oregon, where the fuel tax is replaced by the weight mile tax. So we are developing that solution for each of those markets. In addition to that, there is other compliance legislation around hours of service, which again is another thing that we can make electronic. So there is a huge amount of opportunity in this tax and compliance area. So yes, it is leveraging off everything that we've created to date and adapting it to the different markets that we're entering.
Question from Matt. Congratulations on eRoad's achievements so far. I'm interested in your views on benefits and challenges of being a global company headquartered in Auckland and effectively servicing markets around the world. What are some of the benefits and challenges in that space, Stephen?
Well, I think firstly, the world's become a much smaller place, and comparatively, travel is more cost effective than it used to be. So I think it's more viable than ever to be headquartered out of New Zealand. We certainly start Monday the 1st in the world, which definitely has its benefits. But then we also are on weekend when it's still Friday in the US. So, there are some time and date issues, certainly with things like Skype. It makes it very easy to collaborate across multiple sites. You inevitably have the cultural differences between different countries and different industries. So nothing different really from having a global business operating out of any headquarters. I think trying to do things in New Zealand, such as engineering, we do run into resource shortages, but I think that's becoming more of a global problem. So I think, the tyranny of distance used to be a bigger obstacle. I think it's getting a lot smaller. But if we are going to compete on the global stage, we do have to get up a bit earlier, work harder, and stay a bit later. So I think all those challenges are very easy to manage with the right culture in the business.
So on balance, the benefits outweigh the challenges. And do you find that people are attracted, the engineers and those high-end talent that you're trying to get to New Zealand, are they attracted by the lifestyle, or is that a myth?
Lifestyle is one thing. Creating a nice environment to bring up children's another one. Certainly from some of the recent people we've hired, things like personal safety has also been an issue. But New Zealand has a very nice reputation globally, and it is a great place for people to come to.
Question from Amanda. A few weeks ago, Navman's owners reduced its New Zealand presence to just one salesman and a PA under Kiwi ownership. It used to employ around 400 people in Auckland, of course, as you well know. As someone who was a manager at Navman and very involved in the senior leadership team in the 1990s, do you think in hindsight founder Peter Mayer was wrong to sell it offshore? I imagine this is a question you've been asked many times, Stephen.
Well, I was the guy that actually sold it on behalf of the board, so I was deeply involved. In terms of the Navman which they're talking about, I think they're talking about Navman Car Navigation. So there were 4 business units. The marine business unit under Navico's care, they operate a big engineering team on the North Shore, and that really doesn't get that much publicity. It's an outstanding example of what can be achieved as a global leader. There's, of course, Navman Wireless, which is operating strongly. The car navigation business, that product now exists on a smartphone, so to a large extent that need has gone. In terms of when we sold the business, which is 2003, we had 4 business units which were expanding extremely quickly, and we needed capital in order to fund the growth. I think back in those days there were fewer options to address those things. I think the ability for EROAD to list on the stock exchange, that really wasn't available to us back in that time. So we completed a trade sale, and we were then up to the issues which that caused with the company that bought us.
I think Peter's on record saying that he might have, if he had his time over again, not sold it. But I suppose that's the benefit of hindsight, isn't it?
Yeah, well, I certainly didn't want to sell it, but then I was a minority shareholder at the time, and
right.
Certainly the listing of EROAD at the stock exchange certainly helped to address a number of the things that I didn't like about the Navman sale. So we're very much entrenched as a New Zealand company. with good access to funds for growth.
So there's been some learnings there for E-Road as well?
Yeah, absolutely. I mean, when we sold the business and I retired, my son was 2 at that stage, and would never really get to see what had been created with 13 years of hard work. So the E-Road, so I ended up getting involved in this venture, and certainly with the listing of the business, over the coming decades we'll create a legacy business that we can all be proud of as New Zealanders.
Second question from Amanda. She says it's hard to get some Americans like Larry Ellison or Donald Trump to stop talking about their wealth, toys and success. Do you think there's something in the New Zealand psyche that makes us sheepish about celebrating wealth and success? And is that a good or a bad thing?
I think they're two separate things. I think we don't do enough to celebrate success. I think in terms of how New Zealanders and Americans feel about wealth, that reflects the difference between the two. I think, we're great in this country to celebrate sports success, but business success really doesn't get the same kind of acknowledgement, which I think we should do a much better job. I think people like Peter Jackson have achieved greatly from a business sense, entrepreneurial sense, and we should absolutely celebrate that type of success.
Another question from an NBR reader. Selwyn Pellets Imada about to merge with the Maris family's International Telematics to create a New Zealand-based globally operated fleet management player with roughly the same revenue as you. Do you see them as competition? How is E-Road better?
Okay, so about three components to this. First, I think it's fantastic and really showcases this sort of centre of excellence that we have in New Zealand. So I think that will then be the fourth significant telematics business to come out of New Zealand, including sort of Navman Wireless, Telagis, E-Road, and then this new business. So I think that really shows that there is some real capability in this country. Yeah, there will absolutely be some crossover, but at the same time, the world is a very big place.
After you've raised $46 million, question from Leighton, with your IPO, you said some of it would be used for acquisitions. Have you made any? What sort of companies are you looking to buy?
Okay, so if we look at acquisitions, the purpose of the acquisitions was to allow us to grow quickly and acquire a subscriber base, and certainly acquisitions is one way of doing that. We've looked at 3 so far, and nothing has really met the quality that we're looking for. So we continue to look. But I think there are a number of indirect sales initiatives that we're looking at which are likely to reduce what the underlying strategy was.
Okay, from Natalie, in May, E-Road reported its annual results and you missed the revenue target outlined in your prospectus. I think that was mainly due to a greater popularity of renting rather than buying, so it does have some downstream positive implications for your bottom line. But the question Natalie asks is, does part of you miss being out of the share market spotlight? Is it now harder to set long-term goals, even if they mean short-term revenue or profit hits?
So I think we did very well in our first year. I think the surprise in terms of American customers in particular wanting to rent versus buy the distance recorder that's placed in the truck, that was a bit of a surprise. And the revenue reporting difference on that is what resulted in a lower revenue declared for the current financial year. I think in terms of goal setting, we are very focused on being a global leader in our industry, and I think a key part of doing that in the short term is setting aggressive targets. So we made a conscious decision when we IPO'd that we would provide 2 years of projected financial information as opposed to just 12 months. So, yeah, we will set targets. We will do our best to exceed them. But I think that is the possible outcome of setting aggressive targets.
Do you find, though, that operating as a listed company does sharpen up your performance because you do have a market that's watching your every move?
I think it does. I think you can't be captured by it, but at the same time you need to honour it and be very focused on what you're doing. So everything you do needs to produce a outcome that is measurable in terms of the creation of shareholder value.
A question from Gilbert. What are your top tips for New Zealand companies trying to break into the US market? What are some of the more common mistakes?
I suppose the first one is don't spend any money until you know what you're doing, which sounds like a flippant statement, but if you analyse that, you should really understand your market and if people really are going to buy your product. Key ways to get to that truth is to be customer-led and to hire locals that you can trust as quickly as you can, because what works in New Zealand, Australia or Europe may not work in the US.
Do you find there's also this kind of need to acclimatise to the market as well too, because as you say, they are very different in terms of business philosophies and approaches?
Yeah, absolutely. I think the fact that they speak a type of English or the other way around can be a bit of a misconception. I think in terms of understanding the market, certainly it's been my experience that we've had a lot more in common with Portugal as opposed to some states in the US. So you don't take everything at face value.
First time I've heard us being aligned with Portugal. Second part of the question from Gilbert, he says, why are you making all your sales in Oregon? What's so special about it? Have you got deals lined up in other states as well?
So Oregon has a weight mile tax, very similar to road user charging in New Zealand. So that was the place where we could leverage off the investment we'd made in New Zealand and get going and create a beachhead. So that was the first part of our strategy. The second one was then to move into the neighbouring states, and that's what we are currently doing. And we're setting up sales clusters in Washington, Idaho, and California. So that was that. The Oregon weight mile tax allowed us to create a very unique, defendable point of difference. So that's why we've started there. Now we're well underway in terms of completing our fuel tax product, which allows us to move across North America.
And presumably the success that you've enjoyed in Oregon gives you a good springboard into other states because they can obviously look at the validation processes that you've gone through.
Yes, so it was a very considered approval process that we went through, and part of that process, while it was painful, was to create artefacts to support future approvals in other markets. One thing to note about the Oregon weight mile tax regime, which means any trucks over 26,000 pounds travelling through Oregon need to be registered for weight mile tax. So there's 306,000 of those, of which only 50,000 were actually registered in Oregon. So the other trucks, and that's 306,000, are in the neighbouring states and is as far-flung as Florida.
Question from Kelly. If Auckland goes ahead with congestion charging, is that the sort of thing E-Road would provide technology solutions for?
From a technology perspective, we absolutely have the platform to do with that. I suppose with every business opportunity, you need to do a feasibility study to see if that is something that would be right for E-Road.
Is that are there other territories countries that are coming to you with requests for that sort of technology as well?
Not the congestion charging, but generally alternatives to fuel tax or dealing with specific project-related damage to roading infrastructure.
And Kelly also asks, as someone who's looking at transport worldwide, are Auckland roads truly clogged, or are we just a bunch of sooks?
I like the classic line that Jeff Dangerfield, CEO of NZTA, said, which is there is enough capacity in Auckland. Everyone just wants to use the roads at the same time. I think on a global scale, I think Auckland roads aren't any worse and certainly a lot better than a lot of major cities. I think we are very much impacted by the geography we have in the Auckland area. So it makes it very expensive to upgrade the infrastructure.
And just on the broader point around that, Stephen, how much is technology going to dictate issues around transportation in the future? This is an area, obviously, that we're just really beginning to understand, and you've been pioneering, as you've spoken about in this interview, a lot of developments in this area. But where do you see the big potential moves for technology and transport in the future?
I think there is a huge future ahead for technology and transport. And there's so many different dimensions to it. I think we'll look back in 30 years' time and shake our head in terms of the number of people that got killed and maimed on our roads. They're talking about cars that won't allow themselves to crash being only 5 to 10 years away. I think when everyone goes into having smart cars, which, it might be 50 years away, the cars will be able to tell a central solution exactly where those vehicles want to go, and then those vehicles can get navigated to the best extent through the road network. So I think there is some huge improvements, and if you look at the roads, the reason that they're so wide is because human beings have to have variable quality in terms of them being able to drive on the road. We get tired, we get distracted. So while it sounds a bit futuristic, certainly the roading or transportation problems will be able to be more elegantly solved once that technology's been deployed. But it's a long way away from that. So technology has a big place to play in transportation systems.
So over time, does this also mean that your R&D capacity is going to have to continue to expand quite significantly?
I'm an engineer, so I love R&D, but I'm also a business person, so the size of our engineering will be directly related to the opportunities that we can address. But I'm anticipating that our engineering team will continue to grow.
Yeah, and the idea is not to get too far ahead of the market itself.
Yeah, well, that comes back to understanding your market. If your market's not ready for the technology, then maybe you shouldn't develop it.
Very good talking to you. Thanks for joining us on Ask Me Anything, speaking to E-Road founder and director Steve Newman on NBR Radio.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.